So the Fed dropped interest rates by 0.5% last week, and that got some people talking because the last two times that they've dropped it by 0.5% were during the pandemic and the great financial crisis. Not good company to keep, right? So what does that mean for us as people who are retired or are about to retire in the near future, right? There are a couple of thoughts that I have on this. Well, first of all, the interest rate that we're talking about is the rate that the Fed lends money to banks. So it's not going to be the same interest rate that you'll see in your mortgage or HELOC or auto loans going forward, although there are some downstream effects to that. So eventually mortgages should drop a little bit, HELOCs interest rates should drop, auto purchase loans interest rates will drop. Those are all good things for people who are borrowing, right? It also means that your bond yields will probably drop too. So you might not be getting as much yield as we've been getting over the last couple of years. The double-edged sword to that is that your bond values will go up because bond values move in the opposite direction of interest rates. So there's that. Now, there will be a lot of conjecture around what's happening in the economy, whether it's slowing down, whether there will be a recession, whether we're in a recession. It's hard to really say because there's so many variables that factor into that equation. And you could drive yourself crazy worrying about this stuff too. So what should we do as people who are reasonably sane and are interested in protecting our financial well-being? Well, first of all, if you don't have your cash flow good, it's time to go ahead and make sure that you're either cash flow positive if you're before retirement, or you're hitting that sustainable withdrawal rate if you're already in retirement. So make sure your cash flow is good. Number two, how's your cash reserves? You know, whatever that number ends up being, 3 months, 6 months, 12 months, make sure you're topped off on your cash reserves. You're supposed to replenish those at a regular basis. There are different schools of thought about how much or how frequently you should replenish your cash reserves. But make sure that they're topped off. And if you're still worried, take a look at your overall, what my friend Matthew calls your war chest. The sum total of your cash and bonds that you have in your entire portfolio. Add those numbers up, and then divide that number by the annual expenses, your annual expense number, and see how many years that you have in cash and bonds. Of course, we expect recessions, we expect bear markets. We know that these things are going to happen eventually. That's part of life, right? If you add up that war chest and see how many years of savings you have in cash and bonds, may help you sleep a little bit better at night. We know that bonds will fluctuate not nearly as much as stocks do. Now, should you change your long-term investment strategy? Absolutely not. We expect to be compensated for taking the additional risk in stocks over long periods of time. But in order to get those additional returns, we have to be prepared for those times that we know are coming. Whether the stock market goes up from here or not, who knows? Some people will make predictions, but the truth is it's an educated guess at best. The economy and the stock market may be the most complicated thing that mankind has ever invented. And so there's so many variables that go into this. We don't want to conjecture at this time. We've got a reasonably healthy interest rate environment even with the cuts, so we're getting some yield on bonds and cash. It's not like it was back in 2021 where we were kind of forced to raise interest rates. So you can read a lot into this, whether it's politically motivated. I'm not going to get into that here on this channel. But if you're retired or you're saving for retirement, cash flow, make sure it's good. Cash reserves, make sure they're topped off. And then let your long-term investment strategy ride. It's as simple as that. It is interesting to kind of think about this stuff, but acting on it is a completely different thing. So that's my take on the interest rate drop from the Fed last week. And if you don't have your cash already in one of these higher yield savings or checking accounts, let's go ahead and move that on over. No need to sit there at mega bank and get 0.01% anymore, unless you're just into that. But those are my thoughts. Thank you for tuning in, and I will see you in the next video.